Well, welcome everybody to the Genus annual seminar, where we look at the year past and the year coming. And normally, of course, this is a seminar in person in our building, but this year, along with many other things that are different, this is different. Just going to give, I can see how many people are clicking in, and it's really clicking quickly. So I'm just going to give another minute, and then we'll get started. Click, click, click. So just give people a chance to get in. And I also can start with a couple of housekeeping items. One, if you're on a PC, not on an iPad, if you want to get your browser a little bit bigger, at the very top of your screen on the right-hand side, there is a minus, a box, and a X. So just make sure you press on the box in the middle. That'll either minimize it or make it bigger, so make it bigger. And then also, if you're looking at me, to your right, you'll see a circle with a line through it. If you click that, then I will get smaller and the presentation will get bigger. So that might help you too. So great. With that little housekeeping, one other thing is there's the chat for questions. So please, you won't be able to see each other's questions, but we can see them. So at any point during the presentation, just press the chat line, create a question for us, and we'll do the questions at the end. Let's get started. Just first of all, introduce myself. I'm Leslie Cliff, one of the co-founders and chair of Genus, and I have the privilege today to be a bit of an MC. I am going to go first. I'm going to talk about the review of 2020 and the fact that it was a year of COVID winners and a COVID losers. I'm just going to focus on how our investment team nimbly pivoted through those what was going on during the year. And I'm going to end with a little bit of performance results. Justin, our economist, Justin Hahn, is going to talk about 2021. He's got the heavy lifting for 2021. It's a year of hope, and we have evidence on why it's hopeful. So that Justin will cover that. Mike Thiessen, our director of sustainable investing, he will come and talk about measuring impact and measuring sustainability, not just talking about it. So that should be a good part. We've allocated a few minutes to our new bond manager, Alpha Fix A. We're very, very happy. They have a tremendous track record of performance, and very importantly, they have a commitment to ESG and sustainable investing. Finally, we'll end with Wayne picking up the pieces post-2021 and just the hangover from all the debt. What does it mean longer term? So that's what we have in store for you today. So I get to go first. And again, I'm going to talk about the year 2020, and just it was just really quite an astounding year. What I've got in front of you are the sectors, the big sectors in the stock market. Going from the left-hand side are economically sensitive. The left-hand side, the right-hand side is the economically sensitive area, the energy, financials, industrials. And the left-hand side are what we call the COVID winners, technology, healthcare, consumer staples. And in the middle, there is materials, which is really economically sensitive as well. So what I'd like you to do is just look at the blue bar part of those lines. And if you can see that during March and February, once it became apparent to us that we were dealing with a global pandemic, our investment team were very quick to sell banks, sell energy stocks, sell a little bit of industrials, and buy technology, buy healthcare, and buy consumer staples. And that materials that it shows that it's buying there is really gold. It's not economically sensitive commodities, it's gold. So that was the trade that was done immediately, and that really paid off. And then from the green part are the changes in the portfolio, the equity portfolio between April and December. And you can see that we took a little off the table in terms of healthcare and consumer staples, and added it back into the economically sensitive areas, materials there, not being so much gold, but being more copper and zinc, those kinds of metals, and a big new position in industrials, and buying back some financials. So that is the movement that would happen. And I should say November 9th of 2020, when the vaccine was announced, those economically sensitive stocks started to perform.
Thanks, Leslie. As Leslie discussed, today I'll be talking about the ongoing economic recovery and showing you some indicators we're watching and how we've adapted our portfolios to the changes in the environment. Starting off, we saw 2020 was quite the volatile year for the markets and the economy. We saw extreme stimulus from the governments around the world to help combat the COVID-19 impacts on the economy, and from this chart you can see the extent of it. Almost all major developed nations have spent at least 10% of their GDP on fiscal policies, with Japan leading at over 50% and Germany not far behind at 35%. In addition to all these fiscal policies, we saw central banks around the world act simultaneously and cohesively together. The start of 2020 saw all the central banks immediately cut their rates down to near 0% as quantitative easing round 2 began. The green line here shows the global money supply growth, which rose about 22%, and you can see it was quite a bit steeper and faster than it was in 2008 and 2009. This chart also shows the Global Purchasing Manager Index, or PMIs for short, which has been lagged about 9 months, so it appears to be a lagging indicator relative to global money supply. So the Purchasing Manager Index is just a gauge of economic activity, and when the number is above 50 here, we can see that the economy is expanding, while if it's below 50, it is contracting. Given the extreme money printing that has occurred, we can expect PMIs to continue their rebound upwards into this year and later next year as well. Another indicator we look at, as Leslie mentioned, are commodity prices, particularly more of the economic sensitive ones. From this chart, we can see copper prices have bottomed out around the peak of the pandemic and have been on an upwards trend since then. This is very positive as it shows the economic demand as the recovery is taking place. And in the green line, we can see there's 10-year bond yields, and they have a bit of correlation going back to about 2008 and 2009. Higher copper prices tend to point towards higher US 10-year bond yields, and we expect longer-term yields to rise going forward. And as the economy goes to more normal pre-COVID operations, increased economic activity also is expected to have an impact on inflation. Despite all the negative headlines regarding unemployment rates being at its peak with millions of people being unemployed, we have seen labor costs rise actually. This is because there are parts of the economy that are growing, such as the technology sector, and they continue to thrive. And these sectors tend to have higher wages than the manufacturing and retail sectors that have been hit due to the crisis. This chart also shows the US CPI, the inflation rate, and they're following each other pretty closely. They haven't caught up yet, but we also expect the CPIs to rise due to the economic momentum. This is not all bad news, however. Wayne will discuss this later. Because of the massive fiscal stimulus, it will eventually need to be drawn down, and a higher CPI will eventually lead to a higher nominal GDP, which should help burden some of the debt and some of the impacts there. Moving more towards currency and another economic indicator, this chart shows the Canadian dollar line in blue, as well as oil lines in green. So we can see that oil also bottomed out around the peak of the crisis and has been rebounding going into later in the year when the vaccine news was released, as well as the election results became more clear. And another positive there was the OPEC deal being announced. So this will likely continue the upwards pressure on US oil prices. We can also see from this chart that the Canadian dollar is still considered to be a petrocurrency, and its correlation actually dates back further than this towards the 80s. With the global synchronized economic recovery, we expect Canadian dollar and oil prices to continue upwards. We're projecting somewhere around the 80 cent to 85 cent mark towards the end of the year for the Canadian dollar. Now I'll look more into the market internals. Starting with this chart here, we've always been talking about value stocks and how they underperform, and this chart shows the significant underperformance since about 2016. This chart shows the MSCI US Value Index and its relative performance against the S&P 500. We can see that it began to underperform significantly heading into 2019 and 2020, but it is showing signs of a bottom and have bottomed. We view it as a bottom. We can see that value stocks generally tend to do well during economic recoveries, and we also don't see any reason for it to be much different this year. So we expect this continued upwards trend to go forward into 2021 and 2022. In terms of market valuations, although you are seeing lots of talk about how the markets are overvalued, there are lots of reasons why we view it as fairly valued. This chart represents the 12-month forward earnings yield, which is just earnings divided by price and subtracted by the 3-month bond yields of the respective regions. This generally tells us how expensive or cheap a stock is, and the higher this number, the cheaper it is. Although parts of the market do look expensive, especially in the consumer discretionary and technology area, there are lots of parts of the market that still look cheap, such as utilities and all the value stocks that I've mentioned before, and they are much cheaper in terms of hitting their valuations. We are leaning more towards those areas as well, you will see in the next few charts. And from this chart, we can actually see that Canada in orange and US in blue, that the valuations are actually cheaper than they were pre-COVID. So diving a bit deeper into more of the particular valuations, we can see here that this chart represents the book to price of high dividend yields and the difference between the book to price of low dividend yielding stocks. So the high dividend yielding stocks, you can think more of the banks, while the low dividend yielding stocks, you can think more of the technology sector. Similarly to the previous chart, a higher number means it's cheaper. So as we can see, the dividend stocks have peaked in the terms of cheapness during the peak of the pandemic and have been going down since then. We expect this trend to continue throughout 2021. So tying this all back to our portfolios, this is just a snapshot of our fossil-free CanGlobe weightings, and this is the active weightings. So active weighting means it's relative to the benchmark. So for example, if the benchmark does own a stock and we don't own it, then we will have a negative active weighting in it. You can see here we have very positive active holdings on a lot of the value names and more particularly the high-ranked economic sensitive names. These names include names such as Royal Bank, Manulife, UBS, Magna, and Skanska. On the other side, we are underweight a lot of the growthier names such as Facebook, Visa, and Disney. Similarly, for our conventional fund, this is our Genus CanGlobe fund. We can see that we are holding a similar trend here. We're holding more of the valued names that are well ranked. You'll see some same names here, such as Royal Bank and Magna, and you'll also see East West Bank, while we're underweighting more of the growthier names, such as Disney and Nutrien. You can also see we are still overweighting some of the growthier stocks, but generally we are actively higher weighting in more of the value names. So tying this all back to how we view the world, so this chart just shows the Genus allocation model. So this is Genus dynamics and seeing what we're favoring. So you can see that all these are pair trades. So it's world versus cash. So if it's green, we're favoring the world. And if it's red, we would be favoring cash. So from this, we can see we're still very positive on equities, favoring the world and the TSX versus cash. In terms of fixed income, we're favoring more of the yield products, such as corporate bonds, high yields, and EM debt. And on the commodity side, as mentioned before, we still continue to favor the economic sensitive ones, such as oil and copper. And on the foreign exchange-wise, we are not favoring the US dollar. And this is also kind of showing the increase in economic activity, and the Canadian dollar tends to do well during those times as well. Finally, looking at our portfolio holding, we can compare what we were holding going into 2020 and at the end of 2020. This chart shows that we are actually holding a higher equity weight than we were at the end of 2019. We were at about 66% versus about 63.5%. And in terms of bonds, we are not holding much governments as shown in the previous slide. We're only holding about less than 5% in government products and government-related bonds, and holding a higher active weight in the corporate bonds at about 13% and commercial mortgages at 12%. You can also see we spent a lot of the cash we were holding going into 2020, dropping from about 9.3 to 1.5%. Now I'll pass it over to Mike to discuss how we measure impact and sustainable investing.
Thanks, Justin. So I'm going to be talking about measuring impact because at Genus, we don't just want to be saying that we're making impact. We actually want to measure it. We want to be tracking it. So we'll go through some metrics there. We'll also talk about the sustainable future and what that means for the world, what that means for Genus as well. So first we'll look at fossil fuel reserves. So these are measured in millions of barrels of oil equivalent. And you can see that our fossil-free funds have zero fossil fuel reserves relative to their benchmarks that have quite significant fossil fuel reserves. Now we'll go on to carbon intensity. This is one of the key terms that we use when we're looking at sustainability of funds. And this is measured. This is a measurement of carbon emissions in tons per million in sales. So we're really normalizing carbon emissions so that then we can compare smaller companies with larger companies. And you can see that our fossil-free funds have quite low carbon emissions relative to their, or quite low carbon intensity relative to their benchmarks. Now on to ESG ratings. So this is a rating of environmental, social, and governance of a company. And you can see that our fossil-free funds are quite a bit higher than their benchmarks, especially the fossil-free high impact equity fund. This is a fund that really tries to invest in the best impact companies around the world. So they tend to have operations that are rated higher than the average company. Now looking at the positive impact that our companies are making, we measure positive impact by looking at the percentage of revenue that a company is generating from impactful products or services. So if a company is making 20% of its revenue from an educational product that it's selling, then it would be a 20% impact company. Or if it's making 60% of its revenue through an energy efficiency project, then it would be a 60% impact company. And all of this impact needs to be tied to the UN Sustainable Development Goals, as you can see here. So these are 17 different goals that were created by the UN, and they range from things like healthcare, education, gender equality, renewable energy, and many other areas. We also look at negative impact, so not just positive, but negative impact, and we measure this in the same way. So we look at the percentage of revenue that's being generated by a company that has a negative impact. So if a company is making 30% of its revenue through selling tobacco, then we would label that as a 30% negative impact. And then once we have positive impact and we have negative impact, then we can get a net impact score. So positive minus negative gives us a net impact score. We can do this for companies and for portfolios. So to look at our portfolios, for the fossil-free CanGlobe Equity Fund, so this fund has 11.4% positive impact, 0% negative impact because we make sure we don't have any negative impact in our fossil-free funds. So its net impact is 11.4. And then our fossil-free dividend equity has a net impact of 11%. And if you compare that to our benchmark is 25% TSX, 75% MSCI World. And that benchmark has about 10% positive impact, so quite good there, but then over 10% in negative impact. So its net impact is actually slightly negative. So our fossil-free funds have quite a bit more impact than the benchmark. And now you can actually get these net impact stats on your financial reports or your reporting that you get quarterly. And then if we look at our fossil-free high impact equity fund, this is a fund that's trying to maximize the amount of impact that it's making and also meet financial goals. So it has 58% positive impact, 0% negative, and so its net impact is about 58%. And that's much higher than its benchmark, which is 100% MSCI World. So it has a 3% net impact. So the impact fund is making a lot more impact than its benchmark. Now looking at the sustainable future. So we think that over the next few years, there's many reasons why we're going to see an acceleration in the low carbon economy. We've already seen an acceleration in the past few years, especially last year with a lot of technological advancements. But in the next few years, there's a few areas that are really going to impact this acceleration. So one of them is the Biden climate plan, and I saw a question about this actually in the chat already. But Biden is planning to spend about $2 trillion in the clean energy plan, and that's intertwined with the economic plan. They're pursuing a bunch of other policies as well. A lot of analysts are saying that Biden has actually been more aggressive on climate already than they expected. So that's probably going to be pushing things forward there. Another aspect is prices of clean energy have really dropped. So solar is cheaper than natural gas on a utility scale in many areas of the US, and that's with or without subsidies. And solar prices are estimated to drop about 20% this year as well. And then when it comes to other technologies like hydrogen, prices have been dropping due to new technology, due to scale. So that's exciting there too. Unfortunately, in our financial models, a lot of these hydrogen companies tend to get lower scores in our financial models just because our financial models have a large value weight, and a lot of these companies don't have earnings. Some of them don't have revenue yet. So unfortunately, we haven't been investing in hydrogen yet in our funds, but we'll see what happens in the future. And then other aspects are targets. So in the EU, in the US, also in China, there's quite aggressive carbon emission reduction targets. So this is going to require a lot of capital in order to bring down carbon in these areas, a lot of energy, a lot of focus in this area. And then at Genus, we're continuing to try and improve our products by lowering the risks of our funds and also give more opportunities for impact. So one of the areas that we're looking at lowering risk is by looking into a low carbon screen for our conventional CanGlobe equity fund. So this isn't our fossil free CanGlobe, this is our conventional CanGlobe. And the main reason that we would do this is just to lower risk, because there's a lot of climate related risk involved in companies that are more carbon intensive. They're more open to carbon taxes, as we've seen in Canada, and we'll probably see more of. There's transition risks. There's stranded asset risk. There's cultural backlash, as we've seen in the last few years. Lawsuits have been out against oil and gas companies, very similar to what we saw a few decades ago with tobacco. So we want to reduce this risk in these funds. So we've been looking into this, and performance historically is actually slightly improved in our hypothetical backtests if we were to reduce carbon intensity by 30%. So we're going to continue looking into this and studying this. And in terms of increasing impact, we are planning to launch a fossil-free green bond fund in the next few months. So green bonds are fixed income instruments where the proceeds go towards green projects. So this could be low carbon infrastructure, it could be renewable energy, it's all fossil free, not carbon intense, and would follow our same social screens as well, not just environmental. And it would be high impact. So it would be focusing on affordable and clean energy, innovation, sustainable cities, climate action. And we'd actually be partnering with Alpha Fix. They'd be the ones that would be subsidizing, or not subsidizing, sub-advising this fund. So I'll actually introduce Sebastian right now, the CIO of Alpha Fix, and he can tell you more about the firm.
Thank you, Mike. My name is Sebastian Riom. I'm one of the co-founders of Alpha Fix Capital. Alpha Fix is actually one of the few remaining independent money managers specializing in fixed income, and we have a very strong experience on the corporate credit side. So we have about a little bit more than 20 employees, and we really value having some experienced people. So the vast majority of our portfolio managers actually have more than 20 years experience, and we do think that is something that's going to serve us well given some of the challenges that we foresee in the next cycle. So if I just move to the next slide right here. So just a quick timeline of Alpha Fix. So as Leslie and Mike already mentioned, so we founded the firm in 2008. We were very early adopters of integrating environment, social, and governance factors within our credit ratings, because we just had a very strong conviction back in 2008 that these elements would become more and more material to the financial health of corporate issuers. In case, a point in time, recently, early this week, Standard & Poor's, which is one of the big rating agencies in the corporate world, has just announced that they will be including ESG factors in their overall assessment of the credit rating for the issuers in the oil and gas sector. And the net result from that was actually to announce that the ratings will be downgraded for most of the issuers in that sector. And that's really just a reflection of the fact that once you start integrating these elements into your analysis, you realize that the business profiles may not be as strong. So So I think we have a head start because we've been doing this for quite a bit of time. So since 2008, we've innovated quite a bit. We've built a lot of proprietary tools to be able to evaluate those risks, and that's really allowed us also to bring some interesting products to the market. So for example, in 2017, we launched the first green bond fund in Canada. So today we manage close to 500 million, so that's a very successful strategy. In 2018, we actually started calculating the carbon intensity of our portfolio. So we want to see how much carbon intensity we're consuming versus the benchmark index, also in the evolution. I think that's going to be one of the tools going forward that's going to be very important to follow. It's not just about performance, but also how much of a carbon intensity you're using to generate that performance. In June of 2020, Alpha Fix, actually, our corporate activities became carbon neutral. Again, that's our small contribution to the environment. We're not a big consumer of carbon, but certainly we thought that that was a statement to make. So it's not just something we talk about, it's actually something that we proactively want to do. Just a quick snapshot of our sustainable investment process. So it is a 5-step process. So the first step is to evaluate the integrity of the environment and the social status of the bond. So as Mike's already mentioned, so these are bonds that are specifically tagged to being invested in the use of proceeds to be used in either very favorable environment projects or sociable projects. So what we do is we validate the framework is valid, and we also make sure that the use of proceeds is consistent with best practices. The second step is then to look at the environment and social governance factors. So we've predetermined different criteria depending on the industries, and we rate every issuers according to these predetermined criteria. And this is what I would say where we do a lot of the heavy lifting. So the reality of our world in fixed income is that the majority of the issuers that we have are actually private companies. And private companies tend to be a little bit less likely to be generous on the disclosures. So we have to engage more with them. So we've built our tools, we've built the team to be able to do this. And that's really is the core of what we do on the ESG front. So once we've completed the integrity, the environmental integrity and the ESG factors, we move on to the core one, which is basically making sure that we're comfortable lending to these companies and making sure that we have a very high likelihood of getting paid back those money. So that's just a pure credit analysis that we do. So these 3 steps are then supervised by an investment committee, which is comprised of the 5 most senior people here at Alpha Fix, and that gives us our investable universe. And just to give you an idea of some of the bonds that we find in our investable universe, so the first example I have here is Choice Properties. So Choice is actually the spin-off from the real estate arm spin-off of Loblaws. So the real estate sector certainly is one of the sectors that's gotten beaten up a little bit in the pandemic. The reason we like these bonds is that when you actually, if you look on the right-hand side, you can see the top tenants. So the top tenants of Choice Properties are really focused on providing essential services and actually have done quite well in this pandemic. So low business risk, we assess a low business risk to these bonds, and we view them also as being very favorably supported by some interesting covenants, which unfortunately are getting fewer and fewer in our world. The second example, probably not as well known, is Reliance. Reliance is actually a company that offers water heaters and HVAC services to homeowners. And this is really a very robust business, so very stable and very predictable cash flows, and very also well anchored with regards to covenants. We probably think that this is one of the corporate issuers that has the strongest sets of covenants in the investment world in our universe. So very low business risk profile and very strong covenants again. So those are elements that we look for in terms of the corporate exposure. So the last 2 examples I have are more relating to sustainable bonds and specifically on the environment side. So this is an example of a green bond. So it's a labeled green bond. So it's the province of Quebec who actually came to the market and raised capital to be able to invest in public transit. So you see the use of proceeds there, exactly where the money is going. So when we see these projects come to the market, like I said, we look at the framework, we make sure we're comfortable with the framework, and we make sure that the use of the proceeds is consistent with best practices in terms of having a tangible impact either on the environment or social impact. So this is one example, again, the province of Quebec. The last example I have is a corporate issuer, so Algonquin Power. Again, so they basically raise capital to be able to buy a wind farm. We like Algonquin Power, very focused in terms of renewable energies, very disciplined in terms of acquisition strategies. And again, so nice business plan, very clean, and they've been focusing on renewables for quite a bit of time. So when we, again, use of proceeds, we look at the use of proceeds, we're comfortable with them, and then we're able to determine the impact that it has on the overall portfolio from the environment point of view. So that's really a snapshot of who we are and how we manage. So I'll turn it on to Wayne to conclude on this seminar.
As Justin outlined, our view for 2021, it's rather upbeat. It's fueled by massive central bank stimulation and government spending and the prospects of herd immunity. I want to look at the aftermath of that and picking up the pieces of all this debt we have out there. But the pandemic has been it's been tough on everybody. It's been winter. Summer is coming. And there's going to be a restoration, I believe, of the economy and of our social lives, and the governments have to restore their balance sheets, unfortunately. But here we go. Next chart, please. Well, central banks have printed money like 2008. In 2008, the banks around the world were frozen up, and the central banks printed massive amount of money. They printed money. And they learned from that experience, and they used the same playbook in 2020. In fact, the U.S. Fed expanded their balance sheet from $4 trillion to $7 trillion in a matter of months. It was amazing, but there's issues around that. For example, the Bank of Japan owns 60% of Japanese bonds, and that's an issue in terms of the market's effectively been nationalized. The Fed now owns 30% of U.S. Treasury bonds, and that'll probably go higher. So there are issues around this, and I'll talk more about them. So with this printed money that they printed, they bought many bonds, and if you look and the impact has been dramatic on the bond market. If you look at bond yields around the world, next chart, please. You can see that starting with the very bottom one is the German bonds. They're now at minus 50 basis points. Who wants to buy a German bond yielding minus 50 basis points? It's effectively been nationalized. The same thing with Japan. Rates have been zero there for the past 5 years. Canada and the US are better off. The rates there hit around 50 basis points, went back up to about 1%. We think longer term, the Fed will achieve its inflation goals of around 2%, and maybe you'll get another 0.5% on top of that. Longer term, post-pandemic, we'll settle out probably about 2.5% on a 10-year Treasury, a 10-year Canadian bond. So that's the hope. Longer term, we get a more normalized bond market. Now, these are nominal rates. Let's look at real rates, and real rates are the nominal rates of bonds minus inflation. And pre-2008, government bonds yielded around 2% in real terms after inflation. And that all changed after 2008, and we were stuck in this new normal. And we've been in this new normal where rates are very low, real rates are very low as well, and they've been averaged probably around 0.5% for the past 10 years. I've been using this chart for the past 8 years and telling people one day we'll get out of this. I don't think we will. It'll probably be around for quite a long time because of the massive debt out there. And governments have to keep their rates low because they're paying that back in interest to the bondholders. So we're stuck in this range, and between 1 and 0, probably about 0.5% on average. And so longer term, if the Fed achieves their goal of 2%, you tack on that 0.5%, you get 2.5% for bonds longer term. That'll probably be more of a 2022 story, I would suggest. So the low interest rates, all the money printing, it has ignited some inflation expectations and also a lot of speculation. We've seen all the craziness going on this week with GameStop and what's going on there. That's part and parcel of a lot of liquidity, a lot of money being printed. It's all creating these kinds of wild behaviors. So the money printing has ignited inflation expectations, but a little bit of inflation is actually good. It helps the nominal GDP grow. And the Federal Reserve haven't achieved their goals of the past 10 years in terms of inflation. They were aiming for 2, they came in around 1.5. So they have to do a better job, and I think they're committed to doing that. I think Jay Powell in the past 6-7 months has made a commitment to do that. They have to overshoot almost to achieve that 2% inflation goal, and I believe they'll get the job done. And as Justin pointed out, we see unit labor costs rising. That's going to help get the inflation numbers up in the course of the next year. And one of the phenomena, of course, has been, Bitcoin, gold, Bitcoin. Lots of speculation out there. Bitcoin recently went to 40,000, and part of that was players like PayPal and Square are now using it as tender, so it's becoming more institutionalized. The central banks are looking at what they call CBDC, central bank digital currencies. They want to create their own. They see Bitcoin as having a part in that, but they also want to regulate, and they will regulate. There'll be compliance and all those things. It's obviously these Bitcoin, these digital currencies are being used for money laundering. They want to get on top of that and control that. The SEC is looking into that. There will be more regulation. There's also some security. There's this risk from it being hacked. For example, Ethereum was hacked a few years back. So there's issues around these digital currencies that have to be solved. But right now, Bitcoin looks expensive versus gold. I'd buy gold and sell Bitcoin if I was in that segment. So massive government printing of money and stimulation have lifted the market, but debt is now becoming central and becoming an issue. You look here, this is the debt to GDP for 5 different countries around the world. We selected Japan being the worst offender. Their debt to GDP is over 200, and as I mentioned, the Bank of Japan owns 60% of their bonds. It's been their bond market's been nationalized. Then comes Italy, up around 140%, and the U.S. unfortunately is approaching Italy. They have an issue. They have to get on top of this, and they can get away with it because they're the biggest central bank in the world. They provide all the liquidity, gives them some leeway. Canada and Germany are much better off. You can see they're back around 60%. You can see back in the mid-90s, Canada was up around 90%. And as a smaller economy and smaller country, we don't have as much leeway as the US would. And back in the 90s, we had to take some tough medicine. The Chrétien government and the Harper governments did a lot of cost cutting. They pushed a lot of the costs back to the province and provinces, and they became had to deal with that burden. So how do we turn this around? All this debt. Number one, they have to start by balancing their budgets, and they have some heavy lifting to do in that regard. Let's look at the U.S. Deficit to GDP going back to the 30s, and start off in the 30s. You can see during the Great Depression, the deficit to GDP level was around 4%, and some people say they should have taken on more debt back then and printed more money, and that's how we got out of our Great Recession. But you can see over the past decade, or from 2000, we're averaging around 3 to 4% of deficit to GDP. And this year we're going to print a deficit to GDP, something like a war deficit back in the 40s. So we have to get on top of this. And one way, of course, the number one thing to do, of course, is to balance your budget. But we ran some simulations just to look at the sensitivity of all the different variables. And as I mentioned, cutting your deficit is the most important thing. If you look at the deficit to GDP, look at that ratio. The numerator is deficit, the denominator is GDP. You want the debt to go down and GDP to go up. And GDP is composed of real growth and inflation. So you need some inflation to help to get that GDP up, but you've got to bring the deficit down. We did a lot of work in terms of sensitivity analysis, and the most important factor is getting the deficit down. We ran three, and here I'm showing three different cases. The base case, the center case, is 2.5% GDP, 2% inflation, and deficit to GDP of around 2%. And that just holds the line. It doesn't reduce, doesn't get the problem any better. And what we discovered in our simulations is they have to get the deficit below 2% of GDP. If they can do that, it starts bringing the overall debt numbers down. On the pessimistic side, we put in lower GDP growth of 1.5, inflation of 1, and deficit to GDP of 3.5. And the deficit to GDP of 3.5 is actually better than the last decade. So, there's a lot of work that has to be done here. On the optimistic side, we had GDP of 3, inflation of 2, and deficit GDP of 0.5, and that brings it down from 110 down to 7, to about 60 by the middle of the century. Now, there's three ways individuals, corporations, and governments can get out of debt. They can raise their income, they can cut their expense, or they can sell assets. And to that endeavor, governments, in terms of raising their income, will have to raise taxes. We'll probably see more wealth taxes. We'll probably see a digital tax coming soon to us all, and they'll cut services. And Canada did that in the 90s. They pushed a lot of services, a lot of the costs down to provincial governments, and they also sold assets. I guess they sold Air Canada, for example, back in the 90s. We could sell the post office, we could sell utilities, those kinds of things. So these are things that normally what happens when you get into debt problems. I also believe we're going to see a new political creature come out. I think someone a cross between, say, a Maggie Thatcher and a Mike Bloomberg, someone who wants to solve the debt problem, who's a bit of a technocrat, who wants to re-engineer the government, make it more efficient, improve the healthcare sector, improve education, these kinds of things, cut the costs, but actually make them better. So there's a lot of work to do here. Private sector is re-engineering. It's time government re-engineers and delivers good quality service at a lower price. So let's get on with it. So as I mentioned, as I've shown, the US has some heavy lifting to do. The US, but Canada is actually in pretty good shape. Here's the debt to levels for both Canada and the provinces. And you can see in the mid-90s, Canada had a lot of the debt compared to the provinces. They pushed a lot of their costs down to the provinces as they tried to survive themselves. And recently, you can see they met, and you can see Canada accelerating quite dramatically. We're in good shape. About a 50% jump in debt to GDP is a big jump, and we have to stay on top of this and be ready to put the brakes on this to maintain our long-term viability. I think we have the markets will give us less slack than the US or other big economies, and so I think balancing our budgets is more important in Canada than say in the US. Another bright spot has been the housing sector. If you look at what's going on right now, there's a massive migration from downtown to the suburb as people are able to work at home using Zoom. They want to, and with the pandemic, it's also accelerating that. They want more space. They want a gym. They want a kitchen they can cook in. They want new drapes. So we're seeing that take place right now. And when you buy a house, you spend a lot of things on appliances, on drapes, and everything else. So it's going to help the economy grow, we think, in the coming years. I think it's a long-term behavior. It'll go on for years as we transition with technology to the suburbs. Low interest rates, of course, are helping that as well. And in addition to low interest rate, the consumers are in good shape from a savings perspective. They've been stuck at home. Next chart, please. The savings rate in both Canada and US is back to where it was in the 80s, and there's been some areas that have been hit, like the service sector, for example, but it's pretty good. And government spending has really propped up the consumer. The governments took the debt so the consumer could stay afloat. But the savings rate may stay high, I believe, as individuals see government struggling with their debt, and as they get less faith in big government. So in closing, government saved us in 2008 and 2020. Now they have to save themselves. They truly do. They've put on so much debt. They have to retrench. And I think the era of big government is starting to come to an end. Consumers and corporations are in good shape, but the pandemic has been tough. And the pandemic has been like winter to all of us. And this year, we see a more hopeful year. Spring is coming. Summer is going to probably be here in 2022. And post-pandemic, there's going to be, I really truly believe, a social restoration. You're going to be able to go out and have coffee, have people over for dinner, but it's going to be good for the economy. You're going to travel. So there's going to be good things going on as the economy restores, individuals' lives are restored. But the governments of the world have to restore their balance sheets. But so we have a lot of work to do, but there's good days ahead as well. And that's my presentation.
Great. That was well done, everybody. I think over to you, Grant, if you have any questions that you want to.
Sure. There's actually quite a few questions, so we'll do our best to get to them all, but any we don't get to, we'll endeavour to reach out to you and answer them after the seminar. But the first one here, probably more for Justin, and I'm trying to combine some of these together. I keep hearing the market is expensive. It's kind of near all-time highs. Why do you show it's on the cheap side on the chart? And then another one related to that is, why do we think value stocks will bounce back or continue to bounce back, given they've increased about the same as they did in 2018? So maybe you could put those two together, Justin.
Yeah, so this time around, so starting with the valuation part, a lot of the times we see that, currently we see that the market is more of a stock picker's market. There's a big disparity between a lot of names. We've seen a lot of the tech names reach their highs and blow past their highs, as well as a lot of the more value-oriented names, or the COVID losers, as you may call them. They're nowhere near their peaks before COVID. So this big disparity is the reason why we think that, and based on our analysis, we think that stocks are still fairly valued. There's a lot more names that are in the bottom half than the names at the top half. The top half in the technology sector definitely is a bit more overvalued, which is also why we've reduced a lot of the weight. And going into more of the value stock question, so value stocks did increase in 2018, as we saw, but the performance and the underlying economic factors are a little different. During 2018, we saw a lot of the central banks, such as Canada and the US, begin to raise rates. And then later in 2019, they have said that they were a little early and they jumped the gun a little too quickly on that. This time around, there's a lot more liquidity out there. Central banks are on the sideline for the foreseeable future. Powell came out yesterday. He didn't even want to discuss anything to do with increasing rates or drawing down their balance sheet. So because of this, we expect value stocks to be in a better environment this time around with economic momentum. And that's why we expect a continued outperformance for the value stocks.
Great, thank you. The next one, probably more for you, Wayne. Central banks want and need inflation. Japan has been trying for a decade to create it. What has to happen for inflation to come back?
Well, I think inflation will come back. I'm not sure it'll come back in Japan. Japan's economy is not really an open economy, and that's been their problem. They've been stuck in that mode for 30 years. But I think inflation will come back in the US. They're printing enough money. There's going to be massive government spending. You know, Mike's been talking about it in terms of the Green New Deal. I think inflation is coming in, and our more short-term indicators, like labor costs, are going up. So inflation is going to come back. They're printing enough money. And we're seeing some of the action in for example, Bitcoin and gold and those areas. We're not concerned about too little inflation. Inflation will come back, and I think they have to overshoot, go to 3 or 4% inflation to make sure they end up at 2% longer term. And I think Jay Powell is willing to do that. They're still not even thinking about raising interest rates, and they realize they have to get the unemployment down and also deal with the inequality in the economy. So they're going to keep pushing on this. They've been too tentative. They've actually confessed to being too tentative. too concerned about inflation over the past decade. I think they're now realizing their mistake and they're on top of this.
Great, thank you. Another one here. How will spending cutbacks manifest themselves, and how will normal Canadians feel this lack of spending? Maybe for Wayne again, I'm not sure.
What they do is they nickel and dime. The government's tend to nickel and dime. They'll cut across the whole spectrum. There'll be cutbacks everywhere across the board, and you'll see maybe you'll have to go for an appointment somewhere, and you'll have to pay a service fee for that. It'll just be, and they'll push things down to the provinces and the cities, municipalities. So it might be manifest in higher municipal taxes or higher provincial taxes. So it starts off the top and works its way down to the bottom.
Great. And then one for you, Leslie. It's what changes have we made at the sector level? And I know we had a slide on that. And then a separate question was, really grow back energy positions. Is this because of a long-term view on fossil fuels? I don't know if you want to bring up that slide again, but just to talk about the sector changes and why not back into energy. Oh, I think you're on mute, Leslie.
So I think, Wayne, you should answer this question. So the question is, why have we not got our full position back in energy stocks, given we see the economy improving? And what was the other one, Grant?
Well, it was just what sectors are we rotating into? And I think the slide kind of showed that, but then a follow-on question was, why not back into energy as much? Is that a lot?
Well, we have, yeah, for our conventional accounts that do invest in energy, we have rotated back into energy. We're at benchmark or above in all of our accounts, and but the overall benchmark weight in energy has shrunk over the course of the past decade. So versus the benchmark, we're back in energy, and we see it as being a beneficiary, as Justin said, and as the economy improves. And the Green New Deal will probably is going to impact supply as well. They're going to stop fracking in government properties or government lands. So that's going to be an issue as well in terms of pushing the price of oil up. So we are at market or above in our conventional portfolios.
Well, I'm going to put a line under this, guys, just because I want our clients to spend an hour with us. We will have this. This has been tape recorded, so you can easily get a copy of this if you want to go over it. I just wish you were all in person and I could say hi to you each individually. I truly miss everybody. I miss the social contact, and look forward to having it again one day. And I'd also just remind myself and everybody when I used to fly and the plane landed and the pilot would come on and say, we know you have options and we appreciate your business. I always said to myself, I wish I had an opportunity to say that to our clients. So I'm starting to add that to these opportunities. So thank you. We know you have options and we appreciate your business. A quick thank you to this new format, to the people that keep us straight, particularly Shannon Ward, Graham Farmer, and Daniel Kelly. We couldn't have done this today without you, and we thank you very much for that. And please stay on the line, and if you don't mind, and answer a couple of questions for us so we can do a better job next time. Thank you very much. I look forward to saying hi to everybody. See you next time.